The bullish engulfing pattern is a key indicator in trading, signaling a potential reversal from a downward to an upward trend. It occurs when a large candlestick fully engulfs the smaller preceding candlestick, which must be a negative or bearish candle. This pattern suggests that buying pressure has overtaken selling pressure, hinting at an impending upward movement in price. Understanding and identifying the bullish engulfing pattern can be highly beneficial for traders. It allows them to make informed decisions about entering or exiting trades based on perceived market sentiment and upcoming trends. Recognizing this pattern early can provide traders with an advantage, as it is often a precursor to significant price increases. For those involved in trading, practicing the identification and interpretation of the bullish engulfing pattern, and indeed any technical analysis patterns, is crucial. This process not only hones analytical skills, but also develops an intuitive understanding of market movements. Simulation exercises and reviewing historical trading data can be excellent ways to practice without exposing oneself to real financial risk. In the dynamic world of trading, continuous learning and adaptability are essential. Markets evolve and new patterns emerge while traditional ones may alter. Staying informed, practicing regularly, and being open to adapting strategies in response to market changes can significantly enhance a trader's ability to succeed. Always remember that risk management should go hand in hand with any trading strategy, ensuring that potential losses are mitigated while capitalizing on opportunities that present themselves. Candlestick patterns are crucial tools in technical analysis that provide visual insights into market sentiment and potential price movements. These patterns are formed by the price movements of an asset within a specific time frame and can indicate either a continuation of the current trend or a reversal. They get their name from their candle-like shape, consisting of a body that represents the open and close prices, and wicks or shadows that show the high and low prices during the selected period. Among the various candlestick patterns, the bearish engulfing pattern stands out as a significant indicator of a potential bearish reversal. This pattern occurs at the end of an uptrend when a large bearish candle engulfs the smaller bullish candle from the preceding trading period. The pattern suggests that sellers have overwhelmed buyers, resulting in a possible change in market sentiment from bullish to bearish. In detail, the bearish engulfing pattern is noted by its two main components. The first is a smaller candle that closes higher than it opens, which is followed by a larger candle that opens higher than the previous day's close, but then closes lower than the previous day's open. This formation visually represents a shift in market dynamics where the selling pressure starts to surpass the buying pressure, setting the stage for a potential downward trend. Investors and traders closely watch for the bearish engulfing pattern, as it can signal a time to consider taking profits on long positions or to prepare for a potential entry into short positions. However, like all technical analysis tools, it is most effective when used in conjunction with other indicators and analysis techniques to validate the potential trend reversal. The bearish engulfing candlestick pattern serves as an indicator that a bearish reversal is likely, marking a potential shift from a bullish to a bearish trend. This pattern emerges in the course of stock price movements and is identified when a larger bearish candlestick fully engulfs the body of a smaller preceding bullish candlestick. Specifically, it occurs at the end of an uptrend, signaling a forthcoming downturn. Here is how to spot it visually without charts. Imagine you are observing the price movements of a stock. On the first day, the stock closes higher than its opening price, which results in a bullish or upward moving candle. Think of it as a rectangle whose top indicates the closing price and bottom the opening price, colored in a light shade. On the following day, the situation reverses. The stock opens at a price higher than the previous day's close, but ends up closing significantly lower. This results in a larger rectangle that overlaps entirely over the previous day's bullish candle, this time colored in a darker shade, indicating the bearish turn. The significance of the bearish engulfing pattern comes from its positioning after an uptrend. It suggests that the selling pressure has overtaken buying pressure, leading to a potential decrease in stock prices. Traders and investors often see this as a signal to consider closing long positions or to prepare for potential entry points for short positions, with the assumption that prices might continue to fall. To interpret this pattern in different market scenarios, consider that its reliability may increase when supported by other bearish indicators or high trading volume on the day of the bearish engulfing. Despite the absence of visual charts here, picturing these two contrasting candlesticks side by side with the bearish one completely eclipsing the bullish candle offers a clear signal of the market's changing mood from optimism to pessimism. The bearish engulfing pattern is a chart formation that signals a potential reversal in the market from bullish to bearish. To identify a bearish engulfing pattern, we look for specific features in its shape, size, color, and the engulfment of the previous candle. First, the pattern consists of two candles. The first candle is smaller and is typically green, indicating an uptrend in the market. The second candle is larger and red, signifying a downturn. The crucial characteristic of this pattern is that the body of the second candle completely engulfs the body of the first. This means the opening price of the second candle is higher than the closing price of the first, and the closing price of the second candle is lower than the opening price of the first candle. The significance of the bearish engulfing pattern's position within an uptrend cannot be overstated. For an accurate interpretation, this pattern must occur after a period of ascending prices. It reflects a shift in momentum where sellers have overwhelmed buyers, potentially leading to a price decline. To illustrate, consider a chart where after a steady uptrend marked by consecutive green candles, a significantly larger red candle appears, engulfing the previous green candle. This scenario, situated at the peak of an uptrend, provides a textbook example of a bearish engulfing pattern. Other instances might show variations in the size and shape of the engulfing candle, but the critical feature remains the complete coverage of the prior candle's body. In various market conditions, the bearish engulfing pattern can be a reliable indicator of a potential shift from bullish to bearish sentiment. However, traders often wait for additional confirmation through other indicators or subsequent price action to validate the reversal signal and minimize the risk of false positives. The bearish engulfing pattern is considered a potent indicator of a shift in market sentiment from bullish to bearish. This pattern occurs when a larger red candle fully engulfs the body of a smaller green candle from the previous trading session. The essence of this pattern lies not just in the colors and sizes of the candles, but in what they signify about trader psychology and market dynamics. At a point where the market is characterized by bullish sentiment, investors are generally optimistic, driving prices up. However, when a bearish engulfing pattern emerges, it indicates a moment where the sellers have overwhelmed the buyers within a trading session, leading to a closing price lower than the opening price and significantly lower than the previous day's close. This sudden influx of selling pressure after a period of buying confidence can signal that the bullish momentum is waning and that sentiment is tilting towards a bearish outlook. The immediate aftermath of such a pattern often sees traders reassessing their positions, as the pattern can be a precursor to a turning point where bears might start gaining control. The bearish engulfing pattern, by highlighting a stark reversal in trader behavior and market sentiment, essentially suggests that the confidence among buyers is diminishing and that sellers are starting to dominate. This transition is critical for traders and investors alike, as it may dictate a strategic shift from looking for buying opportunities to considering defensive or bearish strategies in anticipation of a possibly declining market. Understanding and recognizing the bearish engulfing pattern, therefore, enables market participants to better gauge potential turning points in the market, offering insights into when the bullish momentum might be losing steam and when a more cautious or bearish approach might be warranted. The bearish engulfing pattern is primarily recognized as a potential reversal signal in technical analysis. It occurs when a large black candlestick fully engulfs the small white candlestick from the previous day. This pattern is particularly impactful when it appears following an uptrend, suggesting that the bears, sellers have overtaken the bulls, buyers' momentum, potentially leading to a trend reversal. Let's illustrate with two scenarios to understand how bearish engulfing patterns can indicate different market outcomes and the importance of surrounding market context. In the first instance, imagine the market is in an uptrend, showing consistent growth over several days or weeks. Suddenly, a bearish engulfing pattern appears. This large black candle follows a relatively small white candle, completely enveloping it. This scenario suggests a strong selling pressure has entered the market, overcoming prior buying momentum. If this pattern is supported by high trading volume, it signals a robust potential for a reversal from an uptrend to a downtrend. Contrast this with a scenario where the bearish engulfing pattern appears in the midst of a downtrend. Here, it might not signal a reversal, but rather act as a continuation signal, affirming the market's existing downward momentum. While less common than its role as a reversal indicator, the pattern's occurrence in a downtrend serves to reinforce the current bearish sentiment, indicating that sellers are still in control and lower prices may be forthcoming. The surrounding market context is crucial when interpreting bearish engulfing patterns. Other technical indicators and analysis tools should be consulted to confirm the pattern's implications. This might include looking at support and resistance levels, moving averages, or momentum indicators like the Relative Strength Index, RSI, to gauge overall market conditions and sentiment. By considering these additional factors, investors can make more informed decisions when a bearish engulfing pattern appears on the charts. To understand the significance of a bearish engulfing pattern in technical analysis, let's delve into additional indicators and conditions that can validate or weaken its implications. A bearish engulfing pattern is a chart formation that typically signals a potential reversal from a bullish to a bearish market trend. However, the strength of this signal can be considerably affected by other factors. Firstly, trading volume plays a critical role in confirming the bearish engulfing pattern. If this pattern is accompanied by a higher than average trading volume, it suggests a strong bearish sentiment among traders, thereby reinforcing the pattern's significance. High trading volume indicates that a large number of traders participated in the market movement, making the reversal more reliable. Secondly, nearby resistance levels also contribute to the validation of a bearish engulfing pattern. If this pattern forms near a strong resistance level that the price has struggled to surpass in the past, it signals that the bullish momentum is waning and the market may be ready to turn bearish. The resistance level acts as a ceiling that the price cannot break through, and the presence of a bearish engulfing pattern near this level suggests a likely reversal. Lastly, the trend preceding the bearish engulfing pattern is crucial for its interpretation. Ideally, this pattern should occur after a significant uptrend, indicating that the bullish trend is losing strength and may be about to reverse. If the bearish engulfing pattern forms after a downtrend or within a range-bound market, its significance as a reversal signal is weakened. In summary, a bearish engulfing pattern's implications on the future market direction can be greatly reinforced by accompanying indicators such as high trading volume, proximity to resistance levels, and the presence of a preceding uptrend. These factors collectively provide a stronger context for interpreting the pattern, making it a more reliable signal for traders and investors. The bearish engulfing pattern is recognized in the field of technical analysis as a potential indicator of a forthcoming downward trend in the market. This pattern occurs when a large red candle on a chart representing a day where the price has closed significantly lower than it opened, completely engulfs the smaller green candle from the preceding day. Historically, the bearish engulfing pattern has been associated with the reversal of an upward trend, signaling traders about the increase in selling pressure. However, it's essential to underscore the limitations of relying solely on the bearish engulfing pattern for predicting market movements. The historical accuracy of this pattern in forecasting market direction changes is not absolute. Several factors, including market volatility, external economic indicators, and news events, can influence the outcome, leading to false signals. For this reason, experienced traders often recommend corroborating the bearish engulfing pattern with other analytical tools and indicators. Diving deeper, it's also valuable to integrate volume analysis, support and resistance levels, and possibly even fundamental analysis to validate the strength of the bearish reversal signal provided by a bearish engulfing pattern. By combining multiple analytical perspectives, traders can form a more holistic view of the market, thereby improving the reliability of their predictions and making more informed investment decisions. Integrating the bearish engulfing pattern with other technical analysis tools can significantly enhance trading decision-making by providing a more comprehensive view of the market. Here are some ways to combine the bearish engulfing pattern with other tools, alongside real-world examples. Combining bearish engulfing with the Relative Strength Index (RSI). The RSI is a momentum oscillator that measures the speed and change of price movements. A bearish engulfing pattern, when it appears while the RSI is above 70, can suggest an overbought condition and a potential reversal. For instance, if a stock has been in an uptrend and the RSI crosses above 70, signaling overbought conditions, and shortly afterward a bearish engulfing pattern appears, this combination strongly points towards a potential decline in the stock's price. Integration with moving average convergence, divergence, MACD. The MACD is used to spot changes in the strength, direction, momentum, and duration of a trend in a stock's price. A bearish engulfing pattern emerging while the MACD lines are crossing from above to below the signal line can confirm the bearish trend reversal. Imagine a scenario where the MACD line crosses below the signal line, indicating a bearish momentum, and at the same time, a bearish engulfing pattern forms. This dual indicator could provide traders with a strong signal to consider selling or short selling the security, using bearish engulfing with Fibonacci retracements. Fibonacci retracements are used to identify potential reversal levels. Traders could look for the bearish engulfing pattern around key Fibonacci retracement levels such as 38, 2%, 50%, and 61, 8%. If, for example, a stock retraces from its high and stalls near the 61, 8% Fibonacci level and forms a bearish engulfing pattern, it could indicate a resistance level and a likelihood of the stock reversing lower. In essence, by integrating the bearish engulfing pattern with tools like RSI, MACD, or Fibonacci retracements, traders can validate their suspicions of a trend reversal with multiple indicators. This layered approach to technical analysis not only filters out weaker signals, but also helps in building a stronger case for potential bearish reversals, leading to more informed and confident trading decisions. Regarding the bearish engulfing pattern, there are several common errors and misunderstandings among traders. One of the most frequent mistakes is misidentification of the pattern, where traders hastily conclude that any large downward candle following a smaller upward candle constitutes a bearish engulfing pattern. However, for a true bearish engulfing pattern, the bearish candle must fully enclose the body of the prior bullish candle, indicating a strong shift in market sentiment. Another misunderstanding is the over-reliance on this pattern in isolation, without considering the broader market context. The significance of the bearish engulfing pattern can vary greatly depending on its position within a trend, the volume during the days in question, and market conditions surrounding its formation. Assuming the bearish engulfing pattern will always signal a substantial downward move can lead traders to make premature or misjudged decisions. To improve pattern recognition and analytical skills while avoiding these mistakes, traders should adhere to the following tips. Firstly, look for confirmation. After identifying a potential bearish engulfing pattern, wait for subsequent trading sessions to confirm the reversal. A decrease in price on the following day can serve as confirmation of the pattern's bearish signal. Secondly, consider the market context. Analyze the bearish engulfing pattern within the framework of the prevailing trend, support and resistance levels, and other relevant technical indicators. This holistic approach can provide a more accurate assessment of the pattern's implications. Additionally, improve your understanding of candlestick patterns in general. Familiarity with a wide range of candlestick patterns beyond just the bearish engulfing enhances your ability to interpret market signals accurately. Education and continual practice in identifying these patterns within different market conditions will sharpen your analytical skills. Lastly, utilize technology and tools. Various charting software and trading platforms offer features that can help identify candlestick patterns, including the bearish engulfing. Leveraging these tools can help in verifying your interpretations and making informed trading decisions. In conclusion, By recognizing common misinterpretations of the bearish engulfing pattern and applying thoughtful analytical practices, traders can enhance their pattern recognition capabilities and make more nuanced investment decisions. Employing the bearish engulfing pattern in trading involves identifying this specific candlestick configuration and using it to make informed decisions about when to enter or exit trades. The bearish engulfing pattern emerges on a chart when a small green candle, representing an uptick in prices, is immediately followed by a larger red candle that engulfs the body of the preceding green candle. This pattern signals a potential reversal from a bullish to a bearish market sentiment. To use the bearish engulfing pattern effectively for setting entry and exit points for trades, consider the following strategies. 1. Entry point. Traders often view the formation of a bearish engulfing pattern as a signal to enter a short position. This means selling an asset with the expectation that its price will decline, allowing it to be bought back at a lower price. When this pattern appears after a sustained upward trend or at a resistance level, the likelihood of a market reversal increases, presenting a favorable short selling opportunity. 2. Exit point. For traders already holding long positions, the emergence of a bearish engulfing pattern can serve as a cue to exit or sell their holdings to minimize losses or lock in profits. This pattern suggests that bearish forces are overtaking bullish momentum, potentially leading to price declines in the near future. 3. Confirmatory indicators. To increase the reliability of the bearish engulfing pattern as a trading signal, traders may use additional indicators such as moving averages, relative strength index (RSI), or volume analysis. A high trading volume accompanying the bearish engulfing pattern strengthens its validity as a reversal signal. One illustrative case study involves a trader who closely monitored the stock of a technology company. After noticing a bearish engulfing pattern emerge at the end of a several-week uptrend, the trader decided to enter a short position. By supplementing this decision with volume analysis, which showed an increase in selling pressure and an RSI indicating overbought conditions, the trader confidently executed a short trade. Over the following days, the stock price began to decline, allowing the trader to close the position with a profit. This case study highlights the importance of not only recognizing candlestick patterns like the bearish engulfing, but also corroborating these signals with other technical analysis tools for more effective trading decisions. By integrating multiple analytical perspectives, traders can enhance their strategy's robustness and improve their chances of success in the markets. The bearish engulfing pattern is a notable indicator in technical analysis, signaling a potential downward trend in the market. It emerges at the end of an upward trend, characterized by a smaller candlestick fully encased by a subsequent larger downward candlestick. This pattern alone can hint at a reversal, but variations and similar patterns bolster an analyst's ability to predict market trends. One variation to consider is the bearish harami, which inversely mirrors the bearish engulfing pattern. Here, a large upward candlestick is followed by a smaller downward candlestick, which remains within the range of the prior candle. This indicates that the buying pressure is starting to weaken. Another similar pattern is the dark cloud cover, which occurs over 2 days. On the first day, there is a robust upward trend signified by a large bullish candle. The following day opens at a new high but closes below the midpoint of the previous day's candle, suggesting a shift toward a bearish market. The evening star pattern offers a more complex signal of a downward trend. This formation begins with a large upward candlestick, followed by a small-bodied candle or a gap up, indicating indecision among traders. The third candle is a large downward candle that closes well into the first session's body, confirming a bearish reversal. When interpreting these variations, traders often look for confirmation in subsequent candles and consider overall market conditions. For example, the presence of a bearish engulfing pattern at a key resistance level with increasing trading volume can offer strong evidence of an impending downward movement. In depicting these patterns, imagine a chart where the bullish trend is in ascendancy, painting a picture of optimism. Suddenly, a large bearish candle appears, engulfing the prior day's gains, visually marking the change in sentiment. Similarly, the evening star pattern can be visualized as a moment of hesitation in the market, small candle or gap before a significant downward push, a vivid representation of changing tides. Understanding these patterns and their nuances empowers traders to make more informed decisions, using the history painted on the charts to anticipate future movements. Each pattern tells a story of a shift in market dynamics, providing clues to those attuned to their signals.